In this video, I'm going to talk about target date funds. It's going to be a real short video, not going to be very long. Not like my last one. I heard my last one was too long and too much over the top. So in this video, we're going to talk about target date funds. And they are the best option for majority of people. And wherever you work, you more likely will have an option of a target date fund. Actually, most companies default, if you don't pick an option, will default based on your age to a target date fund. And a target date fund is an all-in-one portfolio. It'll have bonds, cash, international stocks, and U.S. stocks. And like Vanguard, I'm going to use Vanguard as an example here. You can go by your birth year. So you'd go along here and what year you're born in. Like my kids were born between 93 and 97. So their target date fund would be 2060. And someone like me, I'll go down here, birth year, I was born 1964. So my target date fund, if I was to put money in a target date fund, would be the year 2030. And these are set it and forget it. Once you pick your target date fund, you just continue to put money into it through your whole working career. And then what I'll show you is what they call the glide path. And the glide path, it shows you how the portfolio changes over time. And then right here, this is assume that you're 25 years old. And if you had the 2060 target date fund, hypothetically, the blue here is U.S. stocks. You can tell down here. Down here I'll tell you the blue is U.S. stocks, the orange is international stocks, the gray is U.S. bonds, the yellow is international bonds, and the blue is, or the dark blue is short-term tips. Them are treasuries. What do I mean there? Okay, so like if you're 25 years old and you had a target date fund like the 2060, you can tell here there's about 55% are going to be in U.S. stocks. Then 55 up to 90%, which is about 35%, is going to be in international stocks. And the last 10% is going to be a combination of U.S. bonds and international bonds. Now you notice you have no money invested in short term at this age. All the way, actually go all the way to, let's see, we'll pull this down to about 62 before you have any short term tips, which is, I'm going to money market, very safe, very secure. So as you can see, as time goes on, that your stocks, which is the orange and blue here, over time, but after age 40, it slowly starts going down. So these are your more riskier assets, and these are supposedly your less riskier, but there is still could be market volatility with bonds. And as you get closer to retirement, you can see, let's say at 65, you're still going to have about, let's see, I would guess about 50% in stocks. That would be a combination of U.S. stocks and international stocks. Even when you're 70 years old, you're still going to have about 40%, maybe 50% in stocks. That's why it's very important that you have exposure to equities. And I talked about that, why you need to have equities and stuff. And, it's just very important. That's where you're going to be able to fight against inflation. And then here, even at 75, they still have you having about 40% stocks. Now, me personally, I'll be fully invested my whole life. But I accept the volatility. But these are the set it and forget it. These are the simplest way to build up your retirement. And also what you got to look at when you put money in your 401k. It's your pension. It's your pension. So that's what it's your pension. I keep saying that. Because if you say 401k, I don't think it resonates as much as your pension. Most people don't have pensions anymore. So the working guy, you got to put money away in the 401k, and you got to do it early. I already talked about the reason why you do it early. It's a lot easier to do it when you're younger. It's always a lot easier. My saying is, it's a lot easier to live poor when you're young than live poor when you're old. That's about the extent of this video. I said it's going to be a real short video. Like I said, even most companies' 401ks will have these target date funds, and that's what I recommend when people ask me. And like I've been saying over and over, don't sound repetitive, is the target date fund. Very easy, very simple. Just set it and forget it. And like I said, most companies, their plans will automatically default you to a target date fund. If you don't pick something, they'll go by your age and they'll stick you in that target date fund. So if you're born between 1998 and 2002, you're going to be in a 2065 target date fund. If you were born between 1993 and 97, they're going to put you in a 26 target date fund. And so on, as you can see. Well, this ends my video, and I'll be doing another one. I try to do one a week if I can. Anything I can say, like I always say, stay positive and definitely stay invested. Till next time, talk to you later.